I don't have the answers. I wish I could come in here as a professor and say, oh, here's exactly what we're going to do. I'm going to fix all these problems, and I don't have the answers. I mean, there's probably a few changes I'm going to have to make, not in a vindictive way, because that's not what it is. It's just in a way to maybe curb in the edges a little bit and say, okay, maybe I got a little too loose here and there on some things, and you know, I'm learning as well. But all of that to say, transitions are weird at this point, but we do need to kind of get to chapter 19. And there's really no good way for me to transition off what I just talked about into chapter 19. So we're just gonna awkwardly transition. And so here, we're gonna go to chapter 19 review material and awkwardly transition to it. Let me pull everything over here. Okay. All right, so chapter 19. This one's income taxes. Hopefully everybody can see it now. And so with income taxes, I think most students on the surface get it. The idea that, the taxes that I pay in a certain year aren't always going to be equal to the income tax expense that I record, just like any other expense, rent expense or salary expense, whatever it might be. The expense and what you actually pay in cash are different things. And so the same is true for income taxes. And so I think conceptually, that's not difficult to understand. I think the implementation of it, because it's a little bit different, I think that can be a challenge for students, namely because the income tax expense is derived from other things. So in other words, it's derived from revenues and expenses. It's not a direct account. It's this indirect account that can get a little bit complicated. And so that's probably the biggest challenge, just kind of thinking about that. It's sort of a side effect of other things. And that's probably the biggest challenge, is that the difference in the income tax expense and the taxes that you pay, it's a side effect of the way that we record income between GAAP and the Internal Revenue Code. And so that's really, I think, the challenge, is understanding and being able to process the fact that this is a side effect. And so what I've done in the lecture guide and at the YouTube lectures and all that is kind of map out a process that allows you to identify those side effects. And I've tried to talk you through how to think about the side effect, but it's something that repeated exposure is really the only way that you're going to get used to understanding it and processing it. So I get the fact that conceptually this side effect is difficult to understand, but hopefully the process that I've laid out is one that you can apply and help you at least sort of apply and get to the amount of the side effect, if that makes any kind of sense. And so in this first example, it's sort of a pretty straightforward type of problem where you buy a computer on July 1st, 2020, you straight line depreciate it under US GAAP, and you use this schedule under the Internal Revenue Code, and where each year is kind of set independently. And so we have a tax rate, we have the income taxes that are payable each year, and so we need to provide the tax related journal entries. And so the first thing that we got to do for this kind of problem is kind of, figure out the income tax. I'm sorry, not the income tax, the depreciation under both methods. And so under US GAAP, the annual depreciation is the original cost, 323,500, minus the residual value, also the salvage value. Those things are synonymous. And then divided over the useful life, which is 2 years. And so that means that the annual depreciation under US GAAP is $161,750. And then in 2020, we only held the asset for 6 months. And so because we only held the asset for 6 months, the depreciation, I'll just kind of type it out a little bit here. We have 161,750 times 6/12, which equals 80,800. Because again, we only hold it for 6 months in 2020. And so the depreciation in 2020 under US GAAP is $80,875. And so the next step, excuse me for 1 second. Almost had to sneeze there. So then the next step then is to get the book values under the two systems. And again, this is my approach, is I use a book value approach. The book uses a similar approach. And it's just because the book value on the balance sheet, it accumulates income effects versus an income statement only shows you the yearly effect. And so in the first year, the cumulative effect and the yearly effect are the exact same, but in a subsequent year, then they're not the same anymore. And that's where it gets a little more complicated. So we just use the book value approach in order to kind of capture that cumulative effect right off the bat. Now, as far as the way that I got this, this book value, just to be a little more explicit, so you take the 323,500, you subtract the depreciation for that year, and that's how we get the 242,000 for the for US GAAP. And then for the Internal Revenue Code, we take the same 323,500 and we subtract the depreciation for that year, which is 165,000. And that's where we get our book value under each system. And so then the next step is to take that difference and see if hopefully it's not too much base. Good. And so the difference between the two is $84,125. Someone asks, yes, the 6 month is from July 1st, 2020 to December 31st, 2020. Good question. And in this case, the book value under US GAAP is more than the book value of the same asset under the Internal Revenue Code because it's that greater than situation. If you remember the lecture, I talked about having a greater than versus less than. This is a greater than situation, which means there's a future taxable amount of income. And that future taxable amount of income is the income effect. But remember, the income tax implication is the side effect. It's the tax effect. And so I need to then apply the tax rate to that difference. And then that amount is the balance in the deferred tax liability. Now I'm going to run a little short on space here. So we're going to kind of maneuver this a little bit. Not so well. We'll go back one. That's fine. And so the DTL balance is $33,650. Again, this is the tax effect from the future taxable amount of income. If it were a future deductible amount of income, then the tax effect would be the DTA balance. All right. So again, future deductible amounts are DTAs, future taxable amounts are DTLs. And so this is a deferred tax liability. Now, in this case, because it's a deferred tax liability, it is going to have a credit balance. It's also the first year in which we held this asset. And so the balance and the entry amount are exactly the same for the first year. So in other words, we're going to credit our deferred tax liability $33,650. And again, the reason why is because there is no prior balance. So the next step then is to do the journal entry, the 12/31/2020 journal entry. Again, we credit the DTL, $33,650. We're also, again, given that the income tax payable is given in the problem as $125,000. That's also going to be a credit. And then from that, we derive our income tax expense to be $158,650. Does everyone understand where we got that first journal entry? Any more questions on that? Okay. Next year. So now the 2021 book values. So under US GAAP, the previous book value is $242,625. In 2021, there's a full year of depreciation. So that's why we subtract another $161,750, which means that the book value at the end of 2021 is $80,875. We similarly adjust the Internal Revenue Code book value, again, the 2020 balance, minus the statutory depreciation. Again, if we go up to the problem, we're told that it's 125,000 in 2021. So it's the statutory depreciation, which leaves us a new book value of $33,500. So then we take that difference. Again, the GAAP book value is more than the Internal Revenue Code for this asset, which means that is a future taxable amount of income. Again, that's the income effect, but we know that with deferred taxes, we're looking for the tax effect. So we apply the tax rate. And so it tells us that our deferred tax liability balance is $18,950. Now remember, in the first year, the balance and the entry amount were the same because there was no prior balance. But again, in this case, we're in the second year and there is a prior balance. Look, we had a DTL balance at the end of 2020. We have a new balance of 18,950 in 2021. And so we need to compare the current balance to the prior balance. So we subtract that prior balance, and that tells us that the DTL entry is a debit. Now, the reason why we know that it's a debit, and I don't know if there's I didn't know of a way to do a symbol on this, by the way. Maybe there is. Oh, wait, I think I can. Give me a second. Insert. You're probably all like, yeah, I know how to do this. I'm trying to see if there's a down arrow. There probably is somewhere. If I can't find it soon, we'll move on. There we go. Down arrow. That's what I want. All right. So there's a decrease in the deferred tax liability. And so that means, again, the deferred tax liability has a normal credit balance. So to decrease that balance, we need a debit entry. And so what that tells us then is we're going to debit our deferred tax liability $14,700. And so we have a couple things here. So we have let me get the last word. So we know that we're going to be deriving our income tax expense, and we're deriving it from the change in the DTL, which is a debit of $14,700, and the income tax payable. Again, the income tax payable is given as $125,000. And so when we derive the income tax expense, we get $110,300. Now, the final year is pretty straightforward. And the reason why it's pretty straightforward is that you can see the book value under US GAAP is $80,875, and under the Internal Revenue Code is $33,500. The depreciation under GAAP is for 6 months, which is the full $80,875. And under the Internal Revenue Code, it's $33,500, which means that at the end of 2022, the book value, if we can kind of get here, oops, sorry, I went a little too far, that's fine. The book value under GAAP and IRC equals 0. All right, so the book value under both systems is 0. So if that's 0, kind of following our math, if there is 0 book value, the difference must be 0. 40% of 0 is 0. And so essentially what we have is we have a DTL balance. Oops, I went too far. So that implies, let me kind of get this, implies the DTL balance equals 0. So since the book value under both systems is 0, it means that the DTL balance is also going to be 0. So the only thing left to do is to get rid of any remaining deferred tax liability balance. And so the balance is $18,950. So that means we need to debit the account $18,950. So again, kind of as we had previously done, we're going to be deriving our income tax expense from the debit to the deferred tax liability, the credit to the income tax payable, which gives us an income tax expense of $106,050. Make sense? Any questions before we move on to the next problem? This is kind of the longest problem that we're going to do. Okay. Let's move on to the next one. So 49er company reports $100,000 in pre-tax financial income, has a tax rate of 35%. And we have these differences between GAAP and the Internal Revenue Code, and there's listed 3 of them here. And we need to calculate our income taxes payable for 2021. And so the differences are this life insurance expense, the depreciation expense is different between the 2 systems, and the treatment of this accounts receivable is a little different between the 2. And so whenever we do this kind of problem, we start with the pre-tax, go up 1. We start with the pre-tax financial income, and we start adjusting from there. Now, first of all, this insurance is an expense under US GAAP, but it's not deductible under the Internal Revenue Code. So if I'm trying to go from GAAP income all the way down to Internal Revenue Code income, I need to add that expense back. The second step then is undo the GAAP depreciation by adding it back, but also make sure that you include the Internal Revenue Code depreciation, again, because we're after the Internal Revenue Code income. And then finally, with the accounts receivable, it would have been recorded as income under US GAAP in 2020, but it needs to be recorded as income under the Internal Revenue Code in 2021. And so we need to add the income from that 2020 accounts receivable. So at the end of the day, our Internal Revenue Code taxable income is $99,850. We apply the tax rate, which then gives us our income tax payable as $34,948. So again, it's just kind of starting with US GAAP and trying to figure out, how do I take this information and use it to reconcile US GAAP income to the Internal Revenue Code income? And again, you just kind of have to think about each one and kind of say, okay, what's the effect here? There's several homework problems that have you do something similar to that. Any questions on that one? All right. 49er Company reports $100,000 in taxable income for 2021. And then we have a tax rate of 40%. Some information here. We have a balance in our DTL. And notice we had a deferred tax liability with a $1,200 balance in 2020. But by the end of 2021, that balance had gone down to $1,025. Similarly, with the DTA, the balance was $1,500 at the end of 2020. By the end of 2021, the balance had gone up $1,660. It's not important what created the change. For this problem, we just need to know that there was a change. And so we want the December 31st, tax related journal entry. So the first step in doing that is to calculate the change. And so again, the change in the DTL went from 1,200 down to 1,025. So that's a decrease of $175. And so since we're decreasing a deferred tax liability, that is a debit entry. With the change in the deferred tax asset, it increased $160. Again, this is an asset. So an increase to an asset is also a debit entry. If the DTL had increased, then it would be a credit. If the DTA had decreased, it would also be a credit, and it could be any combination thereof. All right. But in this case, because of the change in each of those accounts, they're actually both debit entries. And so then we go after our journal entry. Again, we're trying to derive our income tax expense. We have the debit to the DTL. We have the debit to the DTA. And we have our credit to our income tax payable. Again, the income taxes the income was 100,000 and the tax rate was 40%. That's where we get the 40,000. 100,000 times 40%. And so from this information, we can derive our income tax expense of $39,665. Any questions on that? Okay, everybody. Well, if there are no more questions, obviously you can email me and I'll try to respond. I think I'd mentioned in my email, but I am, let me change this. I am leaving for Arizona tomorrow. It's my kid's spring break. So somebody asked, can you explain why there's a debit of $18,950 for number one? Let me reshare that. Hold on. Let me make sure I answer that question first. 18,950. Okay, so the balance in the DTL at the end of 2021 was 18,950. So in 2022, the new balance in the DTL is 0. So that means the DTL entry needs to get rid of that balance. And so that's why we need to debit the DTL $18,950. Now, I will not really have my computer with me, but we're going to the Grand Canyon, and it's not like I'm going to hike with my computer on my back or something. Um, and so, but I will have my phone. And so, if there's an email or a question that you have and I can answer it from my phone, I will. Otherwise, I get back next Friday, and I'll spend, if there's emails that I need to get back, I'll definitely be doing that. Um, the week that we get back, it's a little bit condensed. I'm going to try to have individual appointments, um, but I may not have as many as I typically have, because I'll be dealing with a lot of different things coming back from vacation. Um, so, and so anyway, um, so anyways, sorry, I just got another message that I'm going to respond to. So don't leave. The person who sent me that message, let me respond to that. But anyway, so when I get back, we'll kind of be full in. We'll make sure that we answer questions. I'll have appointments and all that kind of stuff. Um, and outside of that, I know the next test is not too far off into the future. Keep working hard. Um, if you have any questions, just be sure to let me know. And enjoy the weekend. I think we're supposed to have nice weather, so enjoy it. Okay. All right, let me know if you have any questions, and I'll see you guys in about 10 days or so. All right, take care. One second. I know that somebody else had a question. Let me answer this one first, though. Um, so yes, I know the graduation ceremonies and the final exam, there's some conflicts there. I have to do the university schedule. Now, the only thing I will do is I know there are 2 different exam sessions. And so if you need to flip and use the other exam session, as long as you email me, I'm fine with that.
Okay, and I mean, Belk College, they haven't announced when like Belk College's graduation is, so it may not even be on the 13th, but I just noticed it and I wanted to talk about it now before I forgot.
Sure.
Um, but okay, that's fine, and I'll definitely email you if it's a problem.
Okay.
All right, thank you. Enjoy your trip and be safe.
Thanks. Thank you. Take care. Thank you, everybody. Take care, everybody.